Claims don't get denied because people skip insurance. They get denied because of small gaps most policyholders never knew existed. I see it all the time. Someone pays premiums for years, then files a claim expecting help, and hears the worst words possible. Claim denied. Not because of fraud, not because they missed a payment. It's because a policy gap that was hiding in plain sight. Today, I'm going to break down 3 of the most common policy gaps that deny claims and how to avoid them before it's too late. So let's get started. Let's start with number 1, incorrect or outdated property values. Before we talk about exclusions, we need to talk about valuations. Here are some of the biggest reasons claims get denied or underpaid, and it's simple. The property was never insured correctly in the first place. Homes that haven't been reevaluated after renovations. Business equipment that increased in value but were never updated. Inventory limits that no longer reflect reality. Then, when a loss does happen, the insurance company pays based on what was listed and not what you meant to insure. And if the numbers are wrong, the payout is wrong. And in some cases, that gap is large enough to trigger a partial or full denial. Now, that you understand how valuations create problems, let's move to a gap that catches people completely off guard. And that is excluded activities or usage. Insurance is very direct about how something is used. Allow me to share a couple of examples. Personal auto use for business. Homeowners insurance used to cover business activities. Rental properties treated as primary residence. If the usage doesn't match the policy, the claim can be denied, period. And here are a few other examples. I've seen auto claims denied because someone was driving for business purposes and not for personal use. I've seen home claims denied because a side business wasn't disclosed. I've seen business claims denied because operations expanded, but they were not reported in order to expand coverage. Insurance follows exposures. When exposure changes and the policy doesn't, this is where coverage breaks. And finally, the last gap is the one that hurts most, because people assume they're covered. Missing required endorsements or riders. This means that the base policy is not working in your best interest. For example, water backup is excluded unless added. Cyber liability coverage is excluded unless endorsed. Equipment breakdown, business interruption, ordinance and law often excluded unless requested. People assume coverage exists because the policy feels comprehensive. Insurance only pays for what's written on the policy, not what you assume. When the endorsement is missing, the claim stops there. This is where an annual review really matters. Not shopping for other insurance, not guessing what's on the policy. Actually verifying what the policy does and does not cover. Now, how to prevent claims from being denied? Most claims that are denied can be prevented. The denials come from outdated information, change of usage, or missing coverage, not bad intentions. The fix is simple. Make sure to have regular reviews, clear conversations, and make sure the policy still matches your real life. Now, this content was helpful. Please share it with someone who may benefit from this topic. And don't forget to like and please subscribe to the channel. But don't stop here. Check out my next video right here for more insurance and financial tips. And as I like to say, call Jay today. Thanks for listening.